So my name, once again, is Simon Johnson. It's my great pleasure to introduce our closing keynote speaker, Jared Bernstein. Jared was previously chair of the Council of Economic Advisors, and he's currently senior fellow for economic policy at the Center for American Progress. He was confirmed by the Senate in June 2023 as the 31st chair at the Council of Economic Advisors. In that role, as I'm sure you know, he was President Biden's chief economist and a member of the cabinet. He's had a long and distinguished career in.
I wasn't on the Fed board, though.
You get your minute. You get your 5 minutes now in a moment, Jared. Yes, Jared has had many roles, including for a long time as senior fellow at the Center on Budget and Policy Priorities, and also the Economic Policy Institute. He's an expert on income inequality, mobility, employment earnings, international trade, and the living standards of the middle class. And the Q&A will be moderated by Vicky Brogan, who will join him on the stage in a moment. Vicky is a professor at the Sanford School of Public Policy at Duke University, an expert on household finance, inequality, and decision-making at all levels of finance. And more broadly, she was previously an academic advisor to the Consumer Financial Protection Bureau. Jared, over to you.
Thank you. I have some slides if they can get launched. My other policy association now is at Stanford, where I am a policy fellow at the Stanford Institute for Economic Policy Research. There they are. So everything's been said, but not everyone's had a chance to say it. And I'm a little concerned that my comments will be redundant. On the other hand, I do get into something that we haven't talked that much about today, somewhat surprisingly, which is this disconnect between markets and the real economy right now. But I don't know if especially if younger people know what either the references to this magic moment, which is a song that was popular when I was young 100 years ago, this Minsky moment, that name has already come up today. Like many of us, I've distinguished the real economy, jobs and GDP and inflation and wages from financial markets. And it's a distinction that looms large now because the market is viewed as being somewhat untethered from the real economy. But the distinction has, for decades now, always kind of stuck in my craw. Of course, the data show that the market can go off on its own for a while, but it is, in statistical terms, co-integrated with the larger economy. They're not separate entities, and they respond to each other. You know, the old adage that I have always found kind of appealing is that the financial market is like a dog on a leash, held by the dog walker, and the dog walker is the economy in this analogy. And the dog walker plods along fairly predictably while the dog runs ahead, lags behind, pees and poops all over the place, leaving the dog walker to clean up the mess. So that's a pretty good analogy. But what linked the market to the real economy for me was going through the housing bubble, the financial crisis, and the Great Recession. Shortly thereafter, in 2008, Queen Elizabeth II, shown here, famously asked economists at the London School of Economics a very good question: why did nobody notice it? I particularly like this picture because the Duke of Edinburgh appears to be sleeping, which is a good analogy as well. The answer to this question of why did it happen is overdetermined, and Dennis and Simon and others here have more insights than I. Suffice it to say that Better Markets was born of the crisis, and we're all much better off for their existence. But there is an insight that I had at the time, and it flows from this false distinction between the real economy and the markets. One answer to the query of Queen Elizabeth is we didn't have the finance sector in the models. For all intents and purposes, our macro models treated financial markets as a benign force working in the background to distribute excess savings to their most productive uses. And it took iconoclasts like my friend Dean Baker at EPI, we were at EPI at the time, back then, to even see the housing bubble, which he did with very simple charts, just showing the huge divergences of home prices from the gravitational pull of everything else. And Mark Zandi, here with us earlier today, was also raising warning flags. But it's a short leap from there to the Minsky cycle and the Minsky moment, again, familiar to this group. And it forms, I think, strong connective tissue between the real economy and the markets. I'm talking about Hyman Minsky, an economics professor and a banker who died in the mid-90s. And he he understood something that many other economists assumed away, and that's recurring cycles of financial instability. I think Jerry was talking about this in a way that was very resonant to me earlier. The Minsky cycle occurs as the expansion progresses and risk aversion shifts to risk seeking as the financial crisis fades in the rearview mirror. The memory of the damage done by, and Hillary will like this, innovative finance also fades. Speculative bubbles form. Increasingly exotic and complicated financial tools disguise the extent of leverage being doled out to borrowers who are far from creditworthy, and systemic risk proliferates. The Minsky moment follows, or if you like the cartoon version, you have Wile E. Coyote running into midair before he realizes that there's nothing there and descends into the canyon. Often, I liked that cartoon a lot when I was a kid, and I wonder if that's a common thread here, that people with FinReg kinds of early vibes were responding to that. At any rate, what follows at this point are bailouts of the too large to fail institutions. We've talked about that a lot today, be they the big banks or insurance or housing finance shops with hedge fund hustles on the side, or depositors with savings accounts over the limit, as I brought up earlier. Mapping this onto the present day, and again, we've talked about this. I don't think Barry Eichengreen's name has been mentioned, but I thought his warning about the Genius Act is spot on, and I'll get to that in a second. Before I do, let me remind you that as Ryan Cummings and I wrote in a recent critique of non-sovereign digital currencies, crypto stable, roughly half of all corporate spending, although Tom said that this number may be high when I asked him about it earlier, roughly half of all corporate spending in the 2024 election came from the crypto lobby, an amount that converted Trump from a skeptic to a huge booster, and now, of course, a huge profiteer. Now, I experienced the impact of this funding pretty directly when I was making the rounds in the Senate prior to my confirmation hearing to be the chair of the council that you just heard about from Simon. I sat down with Senator Loomis's staff, ready to go through all the important economic issues that I'd be overseeing at the CEA: jobs, growth, inflation, big issues back then, budgets. But all they wanted to hear was that I wasn't interested in going after the digital services industry. She opposed me, so I guess my nuanced answer, which was some version of, it's not going away, but it's got no legit use cases, and we need to keep it. We need to keep it from whacking both the people who don't understand it and the broader economy. So I thought I was giving up something big when I said it's not going away, just like the cockroaches in my New York apartment weren't going away. But it's got no legit use cases, and we need to keep it from hurting people and their communities, those who don't understand what they're getting into, the broader economy. But as I said, she voted against me either way. But I would say that kind of funding that we've talked about, we had a good question earlier about why Democrats take it. It's Minsky cycle rocket fuel, and so what is Eichengreen's argument about this? And this was mentioned on the earlier panel, the run risk embedded in Genius Act. So it's right here. It's pretty straightforward. The act will lead to a proliferation of new stable coins. If passed as precedent, then one or more of those coins will break the buck. In fact, that's already happened, as folks here know. At that point, remember, unlike savings accounts, these stable coin deposits are uninsured, so run risk takes over because everybody wants out before their stable coin also breaks the buck. Remember that Treasury Secretary Bessent, whose agency needs to borrow the money to fund the government, which they just put way deeper into debt, was very excited about all the treasuries they'll sell to back the stablecoin holdings. At this Minsky moment, the stablecoin issuers have to sell, possibly fire sell, their treasury holdings, leading to sharp price declines and sharp yield spikes. And all that's left at that point is to cue the inevitable bailout. Now, it's a reminder, as Dennis said to me recently, that however disconnected markets and the real economy may seem in the expansion, they tend to reconnect to ill effect in the crisis. And what's truly unfair, not to mention maddening, is that some of the biggest players and the biggest systemic risk inducers get rich on the upswing and bailed out on the downswing. We talked a lot about bad economic vibes today, and that's something I had to deal with for years in the Biden White House, particularly around affordability issues. But you should have seen the vibes back in 2009 when people were losing their homes and jobs while we were bailing out the banks. That was when I learned that, quote, moral hazard was more than a question on your micro midterm. There's only one way to block what I've labeled the shampoo cycle, bubble, bust, repeat. And that is, of course, financial regulatory guardrails with adequate capital buffers to protect solvency, transparency, and a constant watch for excesses in imbalanced portfolios that went unnoticed as recently as the SVB weekend, which I remember intimately. That's hard to do when the foxes pay the chickens lavishly to let them guard the hen house, so there are many layers to this challenge. But it's my view that Dodd-Frank, the financial guardrails, and reform legislation passed about 15 years ago, while far from perfect, has worked a lot better than many expected. Let me close with a few thoughts about where we are in this cycle right now. First, I'm not sure the market economy disconnect is as wide as folks think. There's the S&P 493 and the S&P 7. I'm just making those up, but you know what I mean. By which I mean what we call the market is often bifurcated. I thought this was a pretty revealing slide, and it takes you 2 seconds to get these numbers off the internet. The unweighted S&P is up 7% over the past year. The weighted S&P is up more than twice that. Second, corporate profitability as a share of national income is an all-time high. That's corporate profits as a share of income, and traders expect that trend to persist. According to the Wall Street Journal, quoting here, the coolest trade on Wall Street is known as, quote, run it hot. While slowing job growth and tariff-related costs remain primary concerns for investors, the core of the trade lies in betting on an economic resurgence, not a recession. The thinking tax cuts and falling interest rates will heat up the economy, fueling a new burst of growth. Third, while we're starting to see concerning and all too familiar disparities by income class and race creep into the current economy, while the overall unemployment rate has crept up to a still pretty low 4.3%, the black rate just hit 7.5%, and it was 6% just in May. So that's a very sharp increase in a few months. Data that Mark Zandi collects show that consumer spending, which is 70%, almost 70% of GDP, is being driven by the wealthiest households. What you see here is the change in shares, change in spending shares across those income groups. Those have to sum to one, to zero by definition. And you see a clear transferring of spending from the bottom to the top over the last 5 or so years. So, sure, the market is over its skis. I'm not saying it isn't, but maybe it's not as disconnected as it looks. I'm quite concerned about recent developments in the macroeconomy and inflation, the labor market. The administration has planted the seeds of stagflation. They're watering those seeds, and the seeds are sprouting. At the same time, as I just noted, the level of unemployment remains relatively low. And while inflation has been a lot stickier than any of us would like, wage growth is still beating price growth, and that continues to support spending, albeit at the top of the scale. My broader point, one that I hope fits neatly into the presentations and the discussions we've had today, is that whatever the bips and bops of the daily markets and the high-frequency macro indicators that I and others obsess on, Minsky is never far away, and I think that probably sums up a lot of what we've talked about today. His cycle is always ongoing, and his moment is always closing in. Or more accurately, and again, I think this has come out, a lot of really good ideas in the meeting today. It is if we let it. It's up to us to learn from financial history, even as market participants are beset not by, quote, irrational exuberance, but by historical amnesia. Keeping our eyes wide open to that eventuality is surely the right place to start. Thank you.
Well, thank you for those quite interesting remarks. It's nice to get a chance to meet you, and I have been dying to ask you a few questions. So I'm glad to have the moderator's prerogative and to ask some questions that I was really interested in. So the first question I have is centered around your argument that crypto lacks any legitimate use case. And so do you see any role for blockchain outside of speculation and crime? Or put another way, is there something that could change that could cause you to revise that particular view?
It's a great question. I always try to be really open-minded and avoid confirmation bias. I got to associate my, it's a hard question because my knee-jerk answer is not much. I really want to associate myself with, I think it was Hillary's comments, but if it was someone else, they should say who, about how clunky the blockchain really is. And if you ever try to do this, a great book here, probably people have read, Number Go Up. Yeah, so I mean, he's in El Salvador where they're trying to find use cases for this stuff, and he's trying to pay for his hotel using crypto, and it just doesn't work. So he gives him his Visa card, and boom, he pays for his hotel. So I know they're looking for use cases, and I understand payment systems transferring. You know, maybe at some point stable is stable, and crypto is better than a wire transfer or cheaper than a wire transfer. I don't think we're there yet, but I don't see that. I think the lack of use cases, the systemic risk to the economy, the run risk that I took you through on stable, and particularly the use cases for fraudsters and criminals, it's just way too heavy an imbalance. And so if you could find some sort of use case that maybe made a money transfer less expensive, that would not come anywhere clear and come anywhere near offsetting the downside risks.
Thank you. So kind of still on this kind of crypto area, with the, I don't know, neutering of the CFPB, I've been thinking a lot about consumer protections. And so how do you see, when you're thinking about guardrails and regulation, how do you see consumer protection fitting into that framework?
Yeah.
Is disclosure enough, or are stronger limits on marketing and speculation needed in addition, or some other
And we're talking
specific
still about digital currencies?
Yes.
Yeah. I think that there needs to be really a public awareness program as to the nature of the risks. I have witnessed a lot of people and had arguments, again with the Senator Loomis type folks about how, and even some Democrats at one point. I was arguing with Democrats about this, about how it's a great equalizer and how it gives people who have historically been blocked from accumulating wealth to a chance to do so. And I just think that people need to understand the downside risks. Now, the deep-pocketed lobby has much more clout and bigger megaphones than we do, so that's going to be hard. The CFPB under, in the Biden years would have been a great institution to do that, but of course they're not really probably there right now. So I've come, I guess I started out at one point thinking that you really shouldn't have this option just based on my understanding of the history of non-sovereign currencies and how badly they've worked out. But I do believe they're here to stay. And so, yes, I think we just have to really work much harder to inform people about the downside risks and the volatility therein, which, by the way, gets hard when, the Bitcoin sells for over 100,000. It's sort of like almost like telling somebody the odds of winning the lottery, right? They're minuscule, but the upside is billions, and so they keep buying lottery tickets.
So can we unpack a little bit? You talked about the Minsky moment,
Yeah.
and how the kind of amnesia and collective short memory of people in Wall Street and in corporations and regulators. What specific lessons do you think that we can apply from the 2008 crisis with regard to stablecoin and crypto today?
Well, before I think the last phrase of your question is maybe a little too restrictive in the sense that we should talk about lessons. And Dennis recently testified on this. I thought your testimony really answered that question thoroughly. I mean, one thing, and you kind of started out with that in one section. One thing we should be very aware of, it's very simple. I'm not sure we've even talked about it very much today for all the complexities of things we've raised, is simply having adequate capital buffers has proved to be a really effective tool. I think that's a part of the legacy of Dodd-Frank, and obviously that can cut into financial sector profitability. So they fight us on that. I think Anat was also stressing that in her talk. So one thing we've learned is that the importance of those buffers. Another thing we learned, or sort of learned, at least in the back and forth with Jerry earlier in that panel, Jerry Epstein, was the idea that, at least from my perspective, and I've been, in government during some of these meltdowns, the time to worry about moral hazard is not during the crisis. The time to worry about moral hazard is before the crisis, periods like now. In terms of crypto and stable, somebody said this earlier. They thought in 2002 our problems were over, but they weren't. So if we're all right about this, if this group is collectively correct, it kind of should have the seeds of its own destruction built into it. That probably would be true if they weren't so damn lobbied up. So, I think the bottom line here, it's not our task. We have enough to worry about. But the bottom line here is money in politics. That's what's killing us. I mean, the gentleman formerly with the FEC who asked the question, what can we do to keep Democrats taking crypto money? There's nothing we can do other than reform the campaign finance system, which has really devolved in ways that are quite damaging for financial regulation.
So I have a question, and feel free to not answer it if you think it's unfair. It's unfair. If you could put on your, future goggles, 5 years from now, what role, if any, do you think crypto and stable coins are going to be playing in our economy?
I guess, this is a little bit like when people ask me about what's AI going to be doing in 5 years. It's like there's certain things the ratio of what we say about them to what we know about them is very high. Mm-hmm. And that's the case here. I think this group, which is, I think in general, pretty negative about the prospects for digital currencies, either finding a use case or being a particularly reliable speculative tool even. If we're all right, if we're all correct about that, then within the next 5 years, presumably and hopefully that should come to bear. I think people will still trade cryptos, and they'll need stable coins to do so. So maybe it'll be a boutique thing, sort of like a Dungeons and Dragons play. I think that's fine. I think what's worrisome is the systemic risk that when it gets when it gets embedded into the economy, again, in ways that the lobby is kind of thrusting down everyone's throat. The Genius Act is a good example. But I think the seeds of its own destruction should be evident at some point within the next 5 years, such that it's recognized for the highly risky, highly volatile, low use case asset that it is, and becomes a kind of contained trade for people who like to do that sort of thing.
Okay. So let's pivot a little bit away from the kind of crypto stablecoin sphere. And I wanted to talk to you back in August. You wrote a New York Times article that the effects of President Trump's economic policies were just starting to be reflected in hard economic data. And though the soft data evidence, the effects were earlier, but now at the time you said it was just starting to be reflected in hard economic data. Now that another month has passed, what are you seeing, and what are your thoughts on that? So
unlike some of my other New York Times articles, that one was a pretty good call. I said this in my talk. I said the seeds of stagflation have been planted. They continue to water them, and now they're sprouting. And by that I mean that policy appears to be both putting upward pressure on unemployment, which, as I've mentioned, has drifted up to 4.3, At its low, it was around 3.5, 3.4, so that's not a trivial trend, although 4.3 is still relatively low. The black rate has shot up the last few months. That's a noisy variable, so we'll have to see where that goes. But the job creation rate is really low. And at this point, I think job creation over the last 3 months, payrolls over the last 3 months have been under 30K, I mean, 29K on average for the past 3 months. That's way below anybody's break-even label, meaning you need more jobs than that every month to keep the unemployment rate from rising. And lo and behold, the unemployment rate is ticking up. So that's the stag part. What about the inflation part? Stagflation. So inflation is too damn sticky. Every time I see those inflation reports, that's what I see. And obviously, when I was in the White House, we had inflation go to 9%. So I've been there for high levels of inflation, and I'm going to be very, I want to be straightforward about that. Trust me, everybody knows that. But the actions of the Federal Reserve and some of the things we tried to do, you saw inflation really starting to slide down. And it was very clear that the factors putting upward pressure on inflation were very much the deterioration of global supply chains. So it was a supply side problem exacerbated by, to some degree by fiscal policy. So I'm not saying we were blameless, but most of those points of increased inflation were because of the deterioration of the economy's supply side as we went down, as the supply side came back online. You started going down inflation mountain. So we were heading in the right direction. And then they come in there with their sweeping tariff regime, and that put upward pressure on inflation. And we're seeing that. Just look at any plot of goods inflation, because that's where the tariffs most directly hit. Draw a line where the tariffs come into play, and you'll see an inflection point. So it's really clear. At this point, the Yale Budget Lab estimates that north of 60% of these import taxes are being passed through to consumers. And that's probably going to be going up as some of the buffers erode. Buffers being like building up your inventories to front load the tariffs, or taking a hit on your profit margins. That's obviously time limited buffers. Both of those seem to be largely played out. So, I agree with Chair Powell the other day when he argued that we've got two things to worry about. The weight of the risks right now, as he said, was on the labor market, and I agree that. But we have to cross our fingers and hope that the tariffs truly are a temporary or transitory inflationary problem, so that you have a higher price level, but that your inflation rate ends up being okay. If that's not the case, that means they've become more embedded in expectations, and that's really a problem.
So we're kind of in the data area, and so I wanted to talk about data a little bit. With the firing of the Bureau of Labor Standards Commissioner and other kind of assaults on data collection across the U.S. government, how concerned should we be about the integrity of data coming out of this administration? Obviously the markets and the American people can't be fooled by what they see with their eyes. So manipulating the data won't necessarily be a long-term solution to control. But what are the issues and specifically what are the risks to what's going on
Well, first
now?
I'm going to associate myself with your comment just now that, people can tell what's going on out there. And actually the vibes are pretty negative right now, the economic vibes, based largely on the fact that the thing people care most about right now, and every poll shows this, is affordability. Housing, childcare, electricity prices, higher ed. These are all, real stressors for working families. And I find it pretty odd that President Trump, who's really very astute to figuring out what, how to appeal to people and how to appeal to, he has that populist gene of trying to figure out, what people want and at least pretending to give it to them or making it sound like you're giving it to them, that he's behind and endorsed this program to really make the unaffordability problem even worse. So I think that's not only bad policy, it's bad politics, but that's their problem. The integrity of the data remains solid. The people who develop the numbers I think I can't speak for every one of them, but as a group, they're uncorruptible. These are really dedicated public servants who will continue to keep their heads down and do the best work they can to produce the best data they can. But there are many ways to undermine them. You can fail to adequately fund the agency, which is a big project of this administration. And frankly, the agency was underfunded before they got here. I'm talking about the BLS in particular, the census as well. And that's one of the reasons why you're seeing some larger confidence intervals or larger revisions, because survey response rates have gone down and they're not able to pressure some of the respondents to get their data in earlier. So you get 1, 2, 3 chances to respond to if you're in the establishment survey, for example, you get a few chances to respond. And if you don't respond the first time, you'll respond the second or third time, and that's going to change the data. That's behind the revisions. So if you don't have the resources to try to reduce the non-response rates, or to try to reduce the global non-response rates to surveys, which we've actually seen in a lot of countries, that's not the fault of the statisticians. That's the fault of the funders. So part one, the data that they're putting out is still completely reliable because they're the people who are making it are reliable. Remember, the Trumpies never understood this, I don't think. The BLS commissioner has nothing to do with the formation of the numbers in the jobs report. She gets them a day or two before and helps figure out how they're going to present them. But she doesn't. There's no way. There's way too many people involved in cooking that dish to really cook the data. But there are things they can do. I mentioned defunding. The thing that I worry about is sort of the Chinese play, which is you just say, well, we're just not going to release the data. And what I worry about is waking up one day and hearing the Trump administration saying, well, we don't trust the data anymore. We're not going to release it. Maybe knowing these folks, it might be, we're not going to release it unless it's good. So that's that. I worry about the non-release more than I worry about their ability to get in there and cook the numbers.
Okay. So I'll just take one last question before I open up to the group. And this is more kind of a general summary, from what you're seeing in trade, labor, tax, fiscal policy, kind of broadly. What do you think are the primary mechanisms for some of the risks that you've talked about today, how those risks could transmit themselves into financial stability concerns?
I'll just say one so we can get to the audience. I don't think today we've talked about the fiscal debt hardly at all. And this is something I've become worried about. I've been a long time fiscal dove. I've always thought the hair on fire folks about the deficit's going to drown us all, or even that the deficit would lead to higher interest rates, to crowding out of private borrowing and push up the interest rate. I've always thought that was over-torqued and alarmist, and particularly associating myself with the work of Olivier Blanchard, which I recently updated with a couple of colleagues from Stanford, and had a piece in the New York Times on that a few months ago, showing that when the growth rate's higher than the interest rate that you pay on the government debt, you have more degrees of freedom than if that isn't the case. It's not the case right now. G and R, the growth rate and the interest rate, as we show in our article, the way we use the Blanchard techniques to tweak things, but G and R are about equal. And my conviction is that the interest rate is, there's going to be more upward pressure on interest rates going forward than downward pressure. Some people say, well, what about AI? Actually, the history of that kind of technology can put upward pressure on rates because greater demand for capital, which we're certainly seeing in the CapEx space right now. So I am now officially worried that we are on an unsustainable debt path. And one thing I didn't get a chance to ask this question, but I went up to both Mark and Antonio, who are good friends of mine and apparently co-authors. I asked them, is there any chance that private credit is somehow draining investor dollars that might otherwise go to Treasury, lending to the Treasury, to purchase of Treasury bills and bonds? And they were like, that's an interesting question, probably different investors. But, I do worry a little bit about crowd out in that regard, that if if private, just linking this concern to what we talking about today, we can get into this question. If private credit and the demands of private credit are draining credit availability from treasuries to their neck of the woods, that's problematic. That could push up the yields on public debt. And then, of course, the Eichengreen cycle I talked about is another worry in that regard.
Okay, so we'll open it up.
Hi, I've got one quick comment and a question. Classic academic move. So the comment is I wanted to add something to the stablecoin run debate, which I think is often missed, which is that people tend to assume that all stablecoin holders have redemption rights contractually, and that's actually not the case. With USDC, there's tiered redemption rights where the larger institutional investors can redeem and others are the sort of small fish are left having to dump on the exchange at whatever price they can get. So I think
does that change the run risk scenario at all?
No, because I think the big fish are what matter from a run perspective, but it does change the consumer protection angle significantly because, so that's just something to factor in.
Excellent point.
It might matter from a financial stability perspective, but I think it's more a consumer protection. The question I had was, you mentioned that crypto is essentially like a lottery ticket, and I couldn't agree more. It's basically a Hail Mary. And I think part of the problem with our financial system becoming so speculative is that people can't tell the difference between an investment and gambling a lot of the time. And that there are a lot of pressures to gamble given the financial precarity and economic inequality and unaffordability crisis that we're experiencing. So when you say that you think crypto will probably go away, the one pushback I maybe have is if you are in such a precarious space that you feel like you need to gamble for resurrection. And I think this is only going to become more true as healthcare costs increase and people lose their insurance. I do think that this isn't going to go away if it's continually presented as a Hail Mary.
Yeah, it's a great point, and I definitely shouldn't over torque on that happy prediction. So take that with a grain of salt. The correct answer to your question was who knows, but that I thought I'd engage in some wishful thinking there. I wanted to say something else about that investment versus gambling. Anyway, maybe it'll come back to me. But was there a question there, by the way?
It was do you think that is going to impact what happens with crypto and stuff like that, given that people can't see the difference? But does it even people know the difference between pure speculation and investing for the long run?
Yeah, I'm sure not. But I guess if you listen to our conversation today, it seems to me kind of inconsistent with this asset continuing to endlessly appreciate and not revealing its fundamental flaws. Now, that can go on for a while, but it can't go on forever. And that was the origin of my sunny prediction. But unsustainable things can go on for a lot longer than we'd like.
So thank you for being here and thank you for all your service. This actually nicely follows up a little bit on Hillary's first comment. So financial regulation does a lot of things. Today we focused a lot on systemic risk, and I think it is because that's part of what inspired the creation of better markets. It's what brought a lot of us together. It's what brought a lot of us into the field. But there is also the really critical consumer protection aims. A lot of financial policy at times, because we can't deal with affordability, we deal with it indirectly by trying to funnel credit so people can afford things that are otherwise unaffordable. We do a lot with law enforcement. Really the AML burdens are one of the most significant kind of compliance burdens that we placed. There was a lot with sanctions that were not just financial institutions, but a lot of that fell on the financial sector. And I'm just wondering how you thought or how you think about the relationship between the myriad aims that financial regulation is trying to accomplish. Did you ever create hierarchies among them? And just when you're actually kind of working through.
Well, you kind of learn who's good at what. And, when SVB went off that weekend and we were scrambling around trying to figure out what to do. Having Marty from the FDIC, at the table made perfect sense. So at one sense, you sort of worry about the bifurcation and the splitting of all these different agencies. And you're reminded of the old adage that the operation was a success, but the patient died because everybody was working on their own little niche. So you do worry about that. And we've often talked and complained a lot about how disparate all these different regulatory agencies are and how confusing it is. But the fact is that when you're in the midst of a crisis anyway, it's useful to have specialists who you can tap. I know Gary's the guy to ask about this, and Marty's the guy to ask about that. And so, at least in the crisis, that's been useful. I think a deeper question, one which you're a million times more equipped to think about than I am, is just structurally versus the weekend of the crisis, is if structurally all that bifurcation is a useful or a harmful thing. And I think that's a more complicated question.
Thank you for your presentation. So this is a different kind of question. It's about vibes and communication. So it must have been very frustrating being in the Biden administration, because on the one hand, at least my perception is that you all did a lot of very good in terms of infrastructure investment and in terms of Green New Deal style kinds of legislation and so forth. And even in terms of bringing down inflation eventually below what growth of real wages were to some extent. Yet, and I heard you give a presentation at the EPI where you were talking about the vibes and how there were these vibes. There were these vibes that Biden was doing so poorly, and people were so angry. And I'm also been reading your blog about we have to really put forward an alternative argument and set of policies to move ahead. But so this is getting to Dennis's point. Do we all need to get on TikTok? How are we? How do you think? First of all, how do you explain this discrepancy in vibes? And second of all, what can we do about it to get our message across better?
So many things. I learned this political science term that I think I even used in my talk about questions being overdetermined, meaning that they have so many answers that it's hard to know which one is the right one. So let me take this down to one variable, just because it's nice and tight, and I'm sure it's a big part of the problem. Others in the room will say, well, wait, what about these 10 things? And you'll probably be right. But I think the price level is one of the largest and most important factors behind people's negative vibes. When inflation was coming down 9%, 8%, 6%, 4%, I was going out onto a WHNL, White House North Lawn, that's what we called it, where you go talk to the TVs, and saying, we just got an inflation report and it's 2.5%. It's down 6.5 points from its peak. And everybody was like, well, that just means my grocery prices are growing more slowly. I remember my old prices and I want them back, damn it. And that was a vibes killer. Now, you could try to explain to people, well, that would take a massive depression to get the price level that far down, but that wouldn't resonate with them. So that's the answer to the first part of your question. The second part, what should we do about it? I think we need to be talking about affordability. It hasn't come up much today because perhaps it's not our bailiwick here, but also perhaps it should be. And if there's a way to think about affordability in the context of the finance sector, I strongly urge people to do so, because that is the way to get people. That is the only way I can think of to help people believe that you have a better path forward in terms of the economy and the vibes. We have a big project at the Center of American Progress on this. We're going to be releasing something, I hope, in a few weeks on housing affordability. So again, I think that's absolutely essential to moving forward. And the added bonus there is, as I said earlier, the current administration is pushing hard in the wrong direction on affordability. That's a wide opening. If we can't drive through that opening and come up with a better set of policies to convince people we're here to help, on that issue, then woe betide us.
Perfect timing. 4 seconds left. We're back on track, Dennis.
Well, that's terrific, Jared. Thank you very much.
Thank you. Thank you.
Jared is far too humble. He has, I think, about 70 years of public service or so. Is that right?
Yeah, that's what it feels like.
But Jared wasn't just obviously chairman of the Council of Economic Advisors for President Biden, but Jared has been in the fight, in the trenches, really tirelessly working for the values and principles not only on which this country stands, but on which democracy depends, our economy depends, and our financial system for a long, long, long time. So for all of that, thank you very much. We all owe you a great debt. Thank you.